Problem 12.2 explains how to calculate part 2 of cash flow estimation, which is annual cash inflows. And it's part A, B, and C, and I've gone ahead and worked it all out. So there's everything right on the screen. Part A is right there. Part B is there, and part C is there. But I hope to walk you through this, and you'll notice in 12.2, if we read the question, it says Eisenhower Communications is trying to estimate the first year cash flow, that's year one, for a proposed project. The financial staff has collected the following information on the project, and we're given a list of numbers. And in part A, I have put a star next to those items that we are given. So you'll know those are given numbers. Everything else is a calculated number. And as you look at this list, you'll notice sales, operating costs, depreciation, and interest expense. These are all revenue and expense items which show up on our income statement. So the form that you see in part A should not look unfamiliar. In chapter 3, when we put together an income statement, and I told you anytime we use an income statement in finance, this is what it looks like. That's the form I've chosen to use up here in part A. So if you need a refresher on that, go back to chapter 3, watch the income statement video. We have to make one little minor tweak, and there are a couple of theoretical things that I need to walk you through. But if you notice at the top, if you'll recall, sales is at the very top, and sales we're given is 10 million. Operating cost we're given is 7 million. So all I did was take 10 million, subtract 7 million, and I'm left with EBITDA, earnings before interest, taxes, depreciation, and amortization, of $3 million. The next thing I do is subtract out depreciation and amortization, remember. So depreciation comes out next. That's 2 million. That's a given number, which leaves me with earnings before interest and taxes. And here's where things get a little funny. As long as we're calculating operating cash flows, which we are, interest is not involved in this calculation. So you'll notice I totally ignore interest, and that's fine. Interest is wrapped up in my weighted average cost of capital. Remember, one of these capital components is debt, and when we have debt, we have interest. So if I include interest right here, where ordinarily I would, if I include it here, and I include it in my weighted average cost of capital, I will be double counting interest, and I don't need to do that. So interest is avoided. So notice I go straight from EBIT straight down to taxes. And again, the reason I'm avoiding interest is that interest is already used in the weighted average cost of capital calculation. So ignore interest. 1 million minus 400,000 gives me 600,000 and what I'll call operating income. And then to find cash flow, we need to add back depreciation. The reason that we add back depreciation is depreciation and amortization are non-cash charges. And again, we talked about that in chapter 3. So if you need a refresher on depreciation, go back to chapter 3. But once we add back depreciation, the result is our cash flow. So we would take this figure, this $2.6 million, and if we think about a timeline, we said that year 0 was what we're calculating in problem 12.1. That's that negative cash flow. This 2.6 million would be the positive cash inflows for the rest of the year. In part B, it says if this project would cannibalize other projects by $1 million of cash flow before taxes per year, how would this change your answer in part A? So in part B, I've come over here and I've made an adjustment that you see over here. Now, there is an important little phrase in part B. It says it would cannibalize projects by $1 million of cash flow before taxes. So I need to make this adjustment before taxes. So what I do, if you look in this column, this is exactly the same as part A, same numbers and everything. But I jump in here at EBIT, and cannibalization is when a new product eats into the revenue of other products. And cannibalization should be included in cash flow estimation. So there's 3 very important theoretical items that you need to know. Number 1, sunk costs are not included in cash flow estimation. Number 2, opportunity costs are included in cash flow estimation. And number 3, the effects of cannibalization should be included in cash flow estimation. And I'll show you how to do that right here. EBIT, instead of $1 million, according to the information, we're going to lose $1 million to cannibalization. So I'm going to make that 0. If EBIT is 0, then taxes have to be 0. EBIT minus taxes gets me operating income, 0. Then I add back depreciation of $2 million, and cash flow, once I take into account cannibalization effects, is $2 million. In part C, it says ignore part B. If the tax rate dropped to 30%, how would that change your answer to part A? So what I have done is I've started with EBIT. Nothing above that really matters in this calculation, but I started with EBIT, and in white over here I have made my adjustments. EBIT is $1 million, and again we're ignoring anything we did over here in part B. We're resetting back to part A. EBIT, the adjustment is $1 million, but my tax rate, instead of being 40%, which is $400,000 of $1 million, my tax rate decreases down to 30%. So instead of $400,000, I'm only going to have to pay $300,000 in taxes. $1 million minus $300,000 gives me operating income of $700,000, and then I add back my depreciation of $2 million, and my final cash flow is $2.7 million. So a decrease in the tax rate is going to increase operating cash flow, and since operating cash flow is increased, NPV is going to be higher, IRR is going to be higher, MIRR is going to be higher, and my payback period is going to happen faster.